with our featured guest of the morning. He's Lorne Steinberg of Lorne Steinberg Wealth Management. Lorne, first of all, thanks for being here.
Paul, great to be here.
Always great to have you. A lot of investors look at these markets, notwithstanding today's action, which looks like it could be negative, and say, these markets have never been higher, generally speaking, than they are right now. Is it too late for me to put money to work? Should I be waiting for a significant pullback in the indices before I do so?
Right, and there's actually two answers to that question, Paul. First of all, if you own stocks and you felt that way, then you should be selling stocks. And that's, what behavioral finance teaches us. And most people aren't, selling stocks when the market goes down. But most stocks have not done extremely well. Of course, the Magnificent Seven have been the driver of markets over the last few years, with several other tech stocks and a few other things doing well. But there are a huge amount of stocks which have badly lagged the market indices, which offer compelling value, rising earnings, dividends, et cetera. And so there's the stock market, and then there are a whole bunch of individual stocks.
I heard this morning, I haven't looked at it closely on my Bloomberg screen, but the S&P 500 equal weight index, not the S&P 500 that we look at every day, but the one that equal weights all of those 500 stocks has actually come down pretty sharply in recent trading quarters.
Without even having the huge gains that the regular S&P 500 had, which tells you that sectors like the consumer sector have traded poorly over the last several years. Companies such as Disney, Diageo, Starbucks, et cetera, world-class businesses may have hit a snag at a moment in time, Nestle as well, Unilever. These companies will have growing dividends over time, growing earnings over time. They're selling at cheap valuations and offer so much compelling value. They've just been ignored for the last few years. Whereas, a decade ago, these stocks were all hot and trading at mid-20s, low to mid-20s multiples.
A lot of investors are familiar with the price earnings multiple. I think it's fair to say a lot of retail, for a lot of retail investors, that's the valuation metric they look at. As a professional, a veteran professional, what kind of other valuation metrics do you look at to find value?
Certainly for a lot of these stocks, Paul, the free cash flow valuation is critical, because it's not just about what your earnings are, it's how much of those earnings are generating actual excess cash, and what management, how they allocate that cash, what they do. Do they buy back shares, raise dividends, make acquisitions, pay down debt? And it's that capital allocation which is a key determinant of whether management is actually doing a good job.
How do you find free cash flow in a set of corporate results? Because it is sometimes, but not always, broken out separately and clearly identified.
Right, so the classic definition would be to take the earnings, add back the depreciation and changes in working capital, and it's a line that shows up as operating cash flow, and then subtracting the capital expenditures. That's the money that companies spend in order to keep the business going, to put the roof, fix the roof on your house, et cetera. That's money you have to spend every year. So it's after those capital expenditures, what is left over is the excess cash that management and the board decides, do we pay more dividends, buy back stock, or make an acquisition. So
in that context, how important is capital spending, which, as you noted, is a necessary expense, but I know it can be a concern sometimes. Big CapEx companies like the telcos, and we're going to speak about the telcos later this morning, a concern of the market often is rising CapEx over an extended period of time.
So there's a couple of issues with that, because some companies can play with the numbers and can reduce their capital expenditures. And that's the equivalent of, okay, I won't fix my roof this year, I will allow a small leak to develop. That's not a good thing. So if we see companies whose CapEx is declining below normal, that could mean you're going to expect excess capital expenditures going forward. But it's an important number, but it's also part of the allocation. I mean, listen, telcos and a lot of other companies, they have to invest in their businesses. And you need to deduct that, because otherwise you're not going to be able to grow your business.
Okay, I'd love to get your thoughts on the current market environment. The Fed announcement on Wednesday, there's debate about whether it should have been a surprise or not, but the market has certainly reacted to the realization, if you want to call it that the Fed is not likely to cut rates by more than 50 basis points and on more than 2 occasions in 2025.
Sure, and I think, the wording, which is, listen, the Fed is focused on inflation and keeping full employment. And when I looked at the speech from Powell, he's focused on, he said, consumers are dealing with higher prices, even if inflation is moderating, and wages have not yet kept up. And the Fed is adamant they are not going to let inflation creep up as long as Jerome Powell and his team is there. And that means they're going to err on the side of caution. And I think that's ultimately a good thing, because if we saw inflation get out of control, then we'd really be in trouble.
That's Lorne